I have realized one thing: oftentimes, the simplest strategies lead to the greatest results. We as traders often fall prey to complex trading systems. We think that the complexity is directly proportionate to the success rate of the strategy. Therefore, we think that the more complex strategy, the more money you will make. There may be some complex strategies that have a really good win rate. But most of the time, the complexity of the strategy makes it really difficult to execute. So in this video, I will be sharing a very simple swing trading strategy that you can use to find good trend trading opportunities on stocks, Forex, and crypto. But before we start, be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. With that being said, let's get into today's video. First, let's talk about the time frame. Since this is a swing trading strategy, we will use a daily time frame for this strategy. We will use only one indicator for our strategy, which is the pivot points indicator. Pivot points is a simple indicator that plots price levels based on the previous period's price action. Pivot points are extremely popular among day traders, and they are very powerful on smaller time frames. An important point to note here is that pivot points are of many types, like the Fibonacci pivots, Camarilla pivots, etc. But in this video, we will only be using the standard pivot points. The pivot points indicator consists of 7 lines that are calculated based on the price action of the previous day. The line in the middle is called as the central pivot. The 3 lines above it are called as the R1, R2, and R3. These 3 lines are levels of resistance. As the name suggests, we expect the price to face resistance from these levels. On the other hand, the 3 lines below the central pivot are called as the S1, S2, and S3. These lines are support levels, and we expect the price to find support at these levels. The central pivot is calculated by adding the high, low, and close of the previous day and dividing it by 3. In other words, it is the average of the high, low, and close of the previous day. The R1 is calculated by multiplying the pivot with 2, and then subtracting the previous day low from it. Similarly, the S1 is calculated by multiplying the pivot with 2, and subtracting the high of the previous day from the result. Now, I could show you the calculations of all the levels, but in this strategy, we will only use these 3 levels. We will use the central pivot, R1 and S1 in this strategy. I have assigned different colors to each level to make it easier for you to identify them. The white line is the central pivot. The red line is the R1, and the green line is the S1. Since we are not interested in day trading, we will use these same pivots on a monthly basis. So when we go on the daily charts, the pivots will be calculated based on the high, low, and close of the previous month. Now let's understand how to interpret the pivot points indicator. First, we need to talk about the central pivot. The central pivot point can be used as a trend filter for our trading. When the price is in an uptrend, the price will tend to stay above the central pivot. It might fall below the pivot for some time, but for the most part, it will stay above the pivot. Another thing to notice here is that in an uptrend, the price will plot higher central pivots consecutively throughout the uptrend. Therefore, if the current central pivot is above the previous central pivot, this is a sign of an uptrend. Similarly, in a downtrend, we see that the price tends to stay below the central pivot. Another sign of a downtrend is that the price will plot consecutive lower central pivots throughout the downtrend. Hence, if the current central pivot is below the previous central pivot, then we can say that the price is in a downtrend. The central pivot also tends to act as a dynamic level of support and resistance. This means that in an uptrend, we see that the central pivot provides support to the price. And in a downtrend, the central pivot acts as a resistance to the price. So, we could use the central pivot point to enter on pullbacks. Now let's understand how to interpret the R1 and S1 levels. You can think of R1 and S1 as boundaries for the price. Therefore, we expect the price to find resistance at the R1, and we expect the price to find support at the S1. But that is not always the case. In strong uptrends, we see that the price will often break and stay above the R1 for extended periods of time. Similarly, in a strong downtrend, we see that the price breaks and stays below the S1 for long periods of time. The S1 and R1 levels can help us in finding out trend reversals as well. For instance, in an uptrend, the price will tend to stay above the S1 level. Therefore, when the price eventually breaks below the S1 level, it signals that the uptrend might be over, and the price may start a downtrend. Similarly, if the price is in a downtrend, we can see that the price will always stay below the R1. So, when the price breaks above the R1, it is a sign that the downtrend might be over, and the price may start an uptrend. So this is how to interpret the price in relation to the pivot levels. Now, let's talk about the swing trading strategy itself. The strategy that I will share in this video is called as the pivot bounce strategy. It is a very simple strategy that only uses the pivot points to identify trade opportunities. Our goal with this strategy is to identify a good entry point to enter on pullbacks of an already existing trend. First, let us understand the rules for a buy trade. To initiate a buy trade, we want the price to be in an existing uptrend. So first, we want the current pivot to be above the previous month's pivot. Here, by pivot, I mean the central pivot. On this chart, we can clearly see that the current month pivot is above the previous month pivot. Secondly, we want the close of the previous month to be above its R1. When the price closes above its R1, it indicates that there was a bullish pressure on the stock that enabled it to close above its R1. The third rule is that we want the price to touch the central pivot from above. This means that, if the open of this month occurs below the current pivot, then we will not take any trades. We want the price to touch the current month pivot from above. So on this candle, the price touches the current monthly pivot. This means that we have successfully identified a good pullback opportunity in an already established uptrend. So, we want to initiate a buy trade here. For our entry, we can use a couple of techniques. We can simply use a candlestick formation for our entry. For instance, in this case, we see that the candle that touches the pivot is a small hammer come doji candle. This is a reversal candlestick formation, and if we used the candlestick formation as our entry trigger, we would have entered on the close of this candle. We can keep our stop loss below the central pivot, and we can place our targets near the R1. Another technique of entry would be using short-term trend lines. So on this chart, we can create a short-term trend line on the pullback, and wait for the price to break above the trend line for our entry. So our entry would be on this candle, as it breaks and closes above the trend line. Our stop loss and targets would be same as discussed before. And as you can see, we made profits on this trade. Now let's look at the rules of selling. First and foremost, we want the current pivot to be below the previous month pivot. As you can see, this rule is fulfilled here. The current pivot is well below the previous month pivot. Second rule is that we want the close of the previous month to be below its S1. When the price breaks and closes well below its S1, it is a strong indication that the price is in a strong downtrend. As you can see on this chart, this was the last day of the month. We can clearly see that the close on this day was well below its R1. So this was a clear indication that the price was in an existing downtrend. Now, we want to wait for the price to pull back to current month pivot for our entry. On this candle, we see that the price touches the central pivot from below and immediately reverses to the downside. It creates this big candle that closed near its daily low. So if we were looking for a candlestick formation, then this would have been our entry signal. We can place a sell order at the close of this candle. We can keep our stop loss above the central pivot, and we can place our targets at the current S1. Another way of confirmation is by plotting a short-term trend line on the pullback and waiting for its break to initiate trades. So we create a short-term trend line on this pullback and wait for its break. In this case, again, we get an entry on the same candle as before. So we sell here. As you can see, we made profits on this trade as well. This strategy is very powerful, and I suggest you to test it for yourself before investing any money into it. Even if you get 2 to 3 trades per month, you can easily achieve 8 to 10% per month consistently. And that is a pretty good return on investment. That brings us to the end of this video. If you liked this video, then be sure to hit that like button and subscribe to our channel so that you don't miss on any of our new videos. See you soon.